Focus in on banks in particular. We'll talk to the management of BOB to understand their tie-ups with NBFCs for micro-lending, the capital raise that they've undertaken, as well as the recent rate cut by the Reserve Bank. Mr. P.S. Jayakumar is the Managing Director and CEO, Bank of Baroda, with us this morning. Good morning, and thank you so much for taking time out. I'm going to start off with the event that we saw last week, the Reserve Bank and the 25 basis points rate cut. Do you think that was in line with what was required with the system? And how do you think, we're likely to see a transmission of this follow through?
Well, it was in line with expectation as far as the transmission aspect is concerned, since now the loans are, to the retail loans and MSME loans are directly linked to the repo rate. The transmission is kind of automatic. So yes, the transmission effects will happen immediately because consumers can ask for repo linked rate loans, and so that automatically adjusts itself with every change in the repo rate.
Mr. Jayakumar, I was looking at the quarterly update which came from HDFC Bank and Bajaj Finance. Both of them are very large base financial institutions and they've managed to grow. So at a time when the economy is going through a massive slowdown at retail level, big banks are growing. What is the update at your end, and how the festival season retail demand and the borrowing demand has moved on the retail side for BOB?
Well, to the first part, I would say to you that our quarterly results, which was last quarter, we had a 20% plus growth in the retail segment. So yes, the retail sector has been growing. I think the combination of lower interest rates, the festival season, and also a significant outreach being done by the public sector banks and other banks as well should effectively augur well. And therefore, we are expecting a pickup in the credit growth and also a simultaneous pickup in the economy itself.
There is a view in the market which is that there is no liquidity. RBI is maintaining there is enough and more liquidity. That's one view. Second view is that, look, there is availability, but bankers are very selective in lending. And the third view is that bankers are not selective. Corporates do not want to borrow because they feel the environment to do business is not great. So what is the right scenario? Because when we speak to bankers, when we speak to corporates, we are getting a different kind of an assessment from everybody.
Well, here is what I think is happening, at least at Bank of Baroda. I think, and probably true of the other banks as well. I think as far as MSME and retail growth and agricultural growth are concerned, there isn't any real challenge, and consumers are getting them, and they're getting them at lower rates. So I don't see there should be any and you know what happens when somebody doesn't lend to the retail customer, then he automatically switches over to the next bank. So within the system as a whole, there isn't any constraint. As far as the corporate are concerned, it's a combination of things. We also have lack of demand being there with certain corporates. We have a fair amount of requests with respect to infrastructure related spending, some greenfield projects as well. And depending upon the quality of the proposal, these are getting approved. As far as NBFCs are concerned, I think there are two parts over here. NBFCs that only have granular exposure, and does not have significant exposure to real estates, are all getting their funding. Those which have exposure to real estate sector significantly are getting funding through the co-lending route. The co-lending finance itself is begin to start, and it will start picking up as we go through this quarter. So I would think that the liquidity situation as far as NBFCs are concerned is much better than what it was, say 3 months back. And it would get better as the cloud around the quality of the wholesale book kind of gets much more clear. So on the balance, I think the picture is quite positive.
A lot of our interactions with other banks as well as NBFCs seem to indicate that the crux of the problem all lies down to their real estate exposure. Do you also believe that that's where the core problem lies? Up until the real estate sector doesn't revive, which has been in the doldrums for almost 3 years now, we won't really see the real transmission go on into the real economy.
Well, I think when you look at the real estate sector also, there are two parts to it. As far as the affordable housing segment is concerned, they're doing quite well. It's only the more expensive properties that are under pressure for sale. I think part of the problem also is, not part of the problem, part of the change in the consumer behavior is people want to buy completed properties. And therefore, there is a need for a higher amount of working capital for these projects to see the completion through. Yes, I think we need to address the issue relating to the stalled project. There is a 20,000 crore funding that is made available to it. That hopefully will roll out. And we can see some improvement in the real estate sector. But there is a significant change that is happening, which is completed properties versus incomplete property, and affordable housing versus more expensive housing.
Sure. So help us understand, give us a Q2 teaser. I know you're in the silent period, so you can't really divulge many details, but what are the trends like when it comes to deposits, etc., slippages? Are we likely to see some more?
No, we may see, even if we see a continued amount of slippage in this quarter and the next quarter, I think all the problems are on the table. And once some of the NBFC issues stand resolved, I think we are at the peak of the cycle and we'll start declining from here. And that's what I think one of the reports from the Reserve Bank of India also indicated, that the gross NPA numbers would come down, and that's consistent with what we are seeing.
Now,
as far as growth is concerned, I think we are looking at
Go ahead, please.
Yeah, please go ahead. As far as NPA is concerned, the second part of it, the recoveries have been a little bit stubborn over the last 2 quarters, at least for us. We're beginning to see a change in that as the efforts move on. And we are also hoping by the end of the 4th quarter, the unclocking of the NCLT at least, resulting in some of the larger accounts getting resolved, that would make a significant difference overall to the net NPA number. And so I think on the balance, as we look forward for the net NPA number, we stand by our earlier guidance that Bank of Baroda's net NPA would be close to 3%, and 3.95% was the last quarter disclosed results.
The NBFCs, Mr. Jayakumar, we are speaking to, they are pretty much indicating the same point what you said, which is that exposure to real estate is something which is causing a lot of pain. Can I safely assume that till the time real estate sector in India does not stabilize, or till the time prices don't start going higher, we will be in a sticky spot? One account may go bad this quarter, one account may go bad next quarter, two accounts can go bad in the 3rd quarter. But the real estate sector in India has to stabilize for NPAs to stabilize. Can I safely say that is the big picture assessment?
I think, again, when you come to the real estate lending, there are two parts to it, I would say. As far as the banks are concerned, they're far more conservative portfolio. Remember, banks cannot finance land and has got much more, tighter rules. So, and also the exposures, I think, are reasonably balanced because these come under sensitive sectors and tend to get reviewed more frequently. The challenge is with respect to the NBFC exposures to the real estate sector. I think the 2 programs that has been announced, one by the Reserve Bank of India, which essentially is a pass-through financing that can happen, which is called as on lending, and the co-financing routes are available to those institutions, because what banks are finding it difficult is financing on the general pari passu basis. But when it comes to specific assets financing, then there is funding available, and so we need to navigate through that path. So coming back to our own position, we are asking, depending on the type of the company, we are pushing for on-lending program and co-lending program as a more definitive way of having a full view of the risk that is being taken and therefore a willingness to finance. But coming back to the point that you mentioned, the resolution of the real estate sector, I think that is quite key. It's probably sentiment driven, but I do think there is a certain amount of buoyancy in the affordable housing sector.
What was your experience as a banker when last time the interest rates or repo interest rates came to sub 6%? How much demand impetus do you think low interest rates have to play? Do you think low interest rates are a necessary condition but not a sufficient condition for economy to pick up? What has been your experience when interest rates were so low last time?
I think last time when the interest rates were low, if my memory serves correct, there was a fair amount of pickup in demand, right? Now, I think we have to look at the whole picture together. It's not only interest rate reduction that has been happening, that has happened. There's also been actions on the fiscal side with lower tax rates. There's also front-ending of spending on the infrastructure. There is an effort to make sure that many of the outstandings that are there to the MSMEs and other companies and other sectors are being released by government agencies, state government agencies. There is a festival season coming in. There is a good monsoon. So when you package all of these things together, the momentum should move upward. Now, Bank of Baroda, we gave a guidance on GDP growth rate. Our full year guidance is 6.2%. Now, if you then X out and look at the second quarter, we expect it to be 7.2, which is higher than 7%. That broadly is where we are.
I met Mr. Rajneesh Kumar 2 weeks ago, and I candidly asked him that what will happen to your NIMs because of the new repo linkage. And he said, look, I will be able to protect my NIMs. Can I assume the same from BOB also?
Let me answer your question in two ways. One, if no other action is being taken by the government and you were to look by Bank of Baroda, and if you were to look at the pure play effect of the repo rate link, then I think there is a decline of 8 to 10 basis points in the net interest margin, which is that we X out everything else. And what we have seen is in a 2-year kind of a cycle, the transmission fully takes place. So this is really front ending, and then as we go later that will pick up. But we are doing a lot of other things as well. We have better quality assets coming on the board. We are increasing our loan business. We are increasing our margin in our overseas business. So when we take all of these things together, we expect a slight improvement in the net interest margin from where we are today and not a decline.
All right. We appreciate you joining in on ET Now. Thanks much for taking time out, Mr. Jayakumar, and giving us a 360-degree view of how things are shaping up for the bank, the overall system, as well as the economy.